Edelweiss Financial down about 4% Numbers came just a short while back. Operating profit growth has been a little bit muted, coupled with the higher tax outgo as well, which has led to a sequential decline in profit. Rashesh Shah, the chairman and CEO of Edelweiss, now joins in. Mr. Shah, good afternoon. Thanks very much for joining in. The first question, which is what everyone wants to know, have the tough times passed? I heard you speaking in your press conference as well, and you said that, this over-dependence on CPs is down. So are things improving in terms of liquidity?
Yeah, things have improved quite a bit. In fact, though the last quarter was obviously very turbulent and volatile, we still raised close to 8,800 crores of fresh money in the last quarter. And almost about 2/3 of that was more than 1 year. So I think that there was liquidity available, though it was tight. We think if that time things were at 100, they are down to about 50 from a liquidity tightening point of view. We are not completely back to normal, and we think until elections, liquidity may end up remaining slightly tight. But I think that crisis of confidence that was there 3 months ago when the ILFS default happened, that has passed. I think the NBFC industry confidence is starting to come back. The liquidity amongst the NBFCs has been managed very well, and growth is starting to come back. It might take a quarter or two, but I think NBFCs should be back on a much stable, consistent growth path in the next couple of quarters.
Okay, Mr. Shah, if I can just request you to stay with us, sir. There are UltraTech numbers coming through. They're at the bottom of the screen. And Nigel is here, so why don't I just quickly toss it to him for a quick take on the numbers. Nigel.
Well, I think we have the top line number. The revenue from operations has come in at around 8,812. So that's the number, yeah. And that's a little bit better than what we were working with, actually. So the top line looks fine, 8,812. Just all eyes now on the margin front. Let's see what they did. We were expecting a bit of a contract.
15.8%.
15.8%. Okay, so that's a little lower, actually. I wonder why that happened. It appears that, in fact, the 15.8% will be lower than what we were working with, a number of more than 16%. Yes, we were expecting a bit of compression, but this is a little more severe. Let's take a look at a couple of expenditure.
The operating profit is at 1,391 crores.
All right. So the power and fuel costs, that's the one that's hurt them. That's gone up from around 1,500 crores to around 2,000 crores. So that's point number one. Higher power and fuel costs is something that's hurt them. And even there's a bit of a jump up in terms of freight and forwarding cost. So both those two have gone up. Even the other expenditure is up by more than 20%. So when you're not getting that sort of a growth on the top line, but this input cost has gone up, that's not very, very good news. Now we're looking for the sales volumes numbers. Most of the time it comes with a bit of a lag. This time around as well, I don't think we have that number with us as of yet. So we'll be waiting by. Normally there's a presentation that comes. But for the time being, if you're looking at it, on the top line, it appears it's a mild beat. In terms of margins, there is some compression out there, which is not very, very good news. And the PAT number as well has come in at around 450 crores. So this is a mixed set of numbers, actually. What was good for Shree Cement was there was a margin surprise out there. Now, that's not come about for UltraTech Cement. So a few factors that we're looking at. One is the trade segment. That contributes 65% to their total sales. If that number has gone up, then it's good news, because the trade segment, the cement prices are higher than the non-trade segment. Point number one. Second is, how exactly are they managing the power and fuel mix? Because the pet coke, remember, those prices have gone up. So how are they managing the pet coke and coal? And thirdly, and most importantly, what is the difference currently between the cost of production of JP assets as well as the erstwhile UltraTech Cement? So we'll keep an eye out on these fronts. For the timing, we don't have the sales volumes, so we can't really take a call. But as of now, it appears that margins, 15% is the growth that we got there. So the top line beat is because, the domestic sales volumes numbers have come in higher than what we were working with. We were working with roughly around 10.5 to around 11%, but we like the absolute number to come up for you. 17.5 million tons is what we're working with. UltraTech Cement, remember they have the grey sales cements. So we'll have to see what's the breakup of that sales volumes numbers. For the time being, the margin miss is something that the street is digesting.
Okay. All right, Nigel, thanks very much for that first quick take. And Nigel will be back with more numbers, analysis, and, of course, some reactions to those earnings as well. But, we're just going to hop across back to the Edelweiss sort of earnings. Mr. Rashesh Shah is with us, and we are speaking with him. Mr. Shah, thanks for waiting, sir. So you said you raised 8,800 crores in. So could you tell us the source? This is all commercial paper?
No. Only about a small part was commercial paper. In fact, our total commercial paper has come down from 18% to only 7%. Now we have not more than 3,000 odd crores of commercial paper. We raised a lot of about almost 3,000 crores of bank loans and another 3,000 crores of NCDs, especially from retail and high net worth investors and all that. So there has been a lot more all around kind of we were able to raise money from mutual funds, from retail investors and from banks in this quarter. So overall, I think it's been a good quarter from a liability profile strengthening point of view. Commercial paper utilization has come down. And as I said earlier, I think liquidity has started to improve, though I think overall liquidity in the financial market still is very tight with banks and all. And we think with the end of the quarter plus elections around the way, we should see slightly tighter conditions, not as bad it was 3 months ago, but still fairly tighter conditions for the next 4 to 5 months.
Mr. Shah, one concern has been that this story of structural profit growth one can't take that for granted anymore. I mean, it might start again, but it'll take a while as you rebalance your credit mix, etc. Can you talk to us in terms of what's on your mind as far as any guidance you might have?
See, for us, we have been fairly clear in terms of the strategy we had, and the same strategy continues. We continue to grow our retail credit book, that even in the last quarter, there was a fair amount of disbursements. And going forward, we'll continue to scale up the retail because our retail credit book is still fairly small relative to the industry. So there is a lot of growth opportunity in that. We've been doing it for last 3-4 years and we continue to do that. Our wholesale credit book has been stable, will continue to remain more or less stable. We will not aggressively grow that because we have started funds for the wholesale strategies with third-party money, and increasingly those credit strategies are going to move into the fund side. We've been doing this for last 3 years. We recently announced a $1.3 billion distressed credit fund, which is one of the largest funds in Asia. So I think wholesale will move more and more to funds. Retail will be our NBFC will continue to grow on that. ARC, as we said, about 20-25% growth is what we expect going forward because a lot of banks are now selling their NPAs at good prices and good structures. And as you know, we are the leaders in ARC and we continue to look at that. The other good news on ARC is the recoveries have been very good. We have more than 4,000 crores of recovery in this quarter also. So I think recoveries have been very steady. So both new deployment and recoveries on ARC looks very promising. Our asset management, wealth management business continues to grow. On wealth management, we have crossed 100,000 crores of assets under advice. So I think those are structurally growth stories where increasingly as we're getting scale, our cost income ratios are coming down. So overall, I don't see any disruption to the long-term story that was there. Last quarter, we had to hold more liquidity and that came with a cost and it affected our earnings last quarter. We also, encouraged some clients to prepay on the wholesale side. That brought down the book. The book came down by almost 3,000 crores and that also impacted profitability. But our approach has always been when things are turbulent, when there is uncertainty out there, we would rather be conservative. We would rather hold back cash.
Could you, Mr. Shah, could you tell us what is...
Even if it means giving away profit for a quarter or two.
Yeah. Can you quantify that? How much liquidity are you carrying and what is the negative sort of carry impact of that? And how many quarters per quarter? What is the impact estimated? And how many quarters will it last?
So in the last quarter, we ended up handling a lot of liquidity on the balance sheet. So we currently also at the end of the last quarter, we carry about 14,000 crores of what we call balance sheet liquidity. About half of that is overnight liquidity, which is liquidity available overnight to us. And the other half is liquidity that is available in 30 to 45 days. So we look at that, and that 14,000 crores is more than 25% of the balance sheet. So we carry a lot more liquidity. We don't need more than about 8 or 9,000 crores of this kind of liquidity, half overnight and half in the 45-day bucket. So I think we have about, I would say approximately about 5 to 6,000 crores of extra liquidity. And that has costed us about 30 to 40 crores of profit in this quarter, which is not a small part because That's a significant part of the profit. But as I said, this is, temporary, because this will happen in times of crisis when there is a storm coming.
Sure.
You will invest in buying insurance, because we didn't know how bad it would get.
Correct.
Fortunately, the crisis has abated. And in hindsight, it looks like a lot of liquidity, but I think conservatism in financial services always helps.
Mr. Shah, it's a pleasure. Thank you very much. So you're carrying about 6,000 crores of extra liquidity, and it's costing you about 30 to 40 crores in profits foregone each quarter. But as you said, better be safe than sorry. One did not know how much worse the crisis would have gotten, but that is past us now. Thank you very much again for being with us here. We are back to UltraTech, and I must point out the stock has come back into the green. Nigel is still with us here. Nigel.
The whisper number actually was that it's going to be a really bad set of numbers, so that could be one factor. The reason I think that the margins have missed, what we threw up, a couple of reasons out here. They are mentioning in terms of the acquired JP assets. Yes, they have gone to capacity utilization levels of around 75%, but they've said that one of the plants in the central region underwent major overhauling, and the benefits of that will be seen in Q4. So, that could be one of the reasons why the costs have gone a little higher, and that's why, though on the top line it's a little better, because we don't have the absolute sales volumes number. We just know that the domestic sales volumes have jumped up by around 15%. That's what's led to a beat on the top line. Margin contractions to a tune of around 100 basis points. We were bracing for around 40 to around 45 basis points odd. We have some reactions that are coming in there. Rajesh joins us. Hi Rajesh, thanks so much for joining in. You've had some time to look at these numbers. Your initial take on it?
Yeah, hi, good afternoon. Numbers are obviously slightly disappointing from what we were expecting, though top line seems to be, fairly in line. There is no miss at the top line level, but I see other expenses in this quarter is higher. And as you said that because of this maintenance expense, which they would have mentioned, I believe that could be one of the reasons.
Okay.
And obviously, more details on the volume number would be, required before we see operationally how have the realization and cost metrics have moved.
Okay.
Nonetheless, the margins are obviously sequential basis. If I see, the margins have come off from 16.5% to 16%. So that is slightly negative in my view.
Right.
Given that the operating leverage should have played out, cost also has more or less stabilized in this quarter. Margins sequentially should have improved in my view.
Okay, all right. Rajesh, hold on to that thought. We have Mayuresh as well that joins in. Mayuresh, you have had a look at the numbers. Give us your initial take.
No, so Nigel, as you were pointing out, I think if the volumes are, as you're mentioning, they are a good set of numbers from a volume perspective. What has probably happened in terms of stickiness of realizations is something that would have got played out on the top line. The margin is a miss, but as you're saying, if there is a overall on one of the plants, I think that might have been one of the factors going forward. So how do these cost synergies start building into their balance sheet over the next few quarters? Because freight costs definitely are coming down. You're probably also seeing the other elements of incremental cost burden coming down. And what probably happens in terms of the sweating of assets, I think that is extremely important. The other point that you're probably mentioning, Nigel, I think is going to be very critical as well. I think how the trade segment has performed, the white cement realizations, and third, I think the production cost differential between JP assets and UltraTech. Last quarter, I think it was around 35 rupees a ton, which excluded the statutory costs, including around 70 rupees per ton of the acquired mines. What happens on that front, whether they are able to marginalize or minimize that cost, is going to be extremely critical. And again, I think what probably happens in terms of the new acquisitions and the volume growth that they can drive in terms of asset sweating going forward.
Okay, all right. Just hold on to that, gentlemen. I'll just tell my ticker team, actually, the sales volumes number actually should be 18 million tons. You know, to compare it on a like-to-like basis, the total sales volumes, the poll for that was 17.55 million tons approximately. So we'll just correct that number. The sales volumes actually are a little better than what we're working with. It's at around 18 million tons. That's the number, because in the standalone entity, you're referring to the total domestic sales plus clinker plus the exports. So it's actually 18 million tons. That compares with our poll of around 17.5 million tons. That's a little better actually, and that's the reason why there's a bit of a beat on the top line itself. So let's get that number up for you. In terms of domestic sales, that's up by close to around 14%, and in terms of exports, that's up by around 13%. That's telling you that the total volumes have grown by around 14% in comparison to around 10.5 to around 11% that we are working with. Rajesh, the volume numbers are in. Your comment on it, 18 million tons is the total volumes. Domestic is coming at around 17.1 million tons.
Yes, so I see on a blended volume 18 million tons. Sequentially, there is a 15% volume growth.
Yeah.
Realization, however, on a totality basis is down 2% sequentially.
Yes.
Though we were modeling in 1% sequential dip, 2% is slightly higher. On the input cost front, I generally see raw material and power together. That sequentially is largely flattish, which is a healthy sign. Now, the only thing is that sequentially there is no moderation in other expenses. Ideally, with volume growth, that should have come down. In terms of freight cost, there is a marginal moderation, which is good.
Okay.
So I believe the other expenses, there was some room for, if that was a large one-off, which the company, which they may clarify in the call.
Yeah.
Because one more thing is that they have been talking that the JP's numbers should start to improve in subsequent quarters.
Yeah.
And second, their management has also been guiding that they will improve the trade sales.
Correct.
Which earlier was 75%.
That's come down to
2 year
60.
back.
Yeah.
Yes, 65 was in last quarter, and they have indicated that they will go back to 70%.
Okay.
So trade sales improvement will boost margins. So those details are awaited.
Okay. All right. Thanks so much, Rajesh, as well as Mayuresh, for joining in and giving us those details. So, well, that's the verdict, Prashant, on UltraTech Cement. Volumes are a little bit better than we're working with. Realizations appear there's a bit of a miss, and they had some extra overhauling cost on one of their central India's plants, and that could explain why the margin compression is a little extra than what we were working with. It's at around 100 basis points. We were working with margin compression of around 40 basis points. So a mixed set of numbers coming in there, but not as bad as the whisper number, actually.
Okay, Nigel, thanks very much for that. That is UltraTech for you. So a couple of numbers in quick succession. The big other one is going to be Yes Bank, and that should be out in the next, 30-40 minutes or so. I'm going to wrap up this edition of Mid-Cap Radar. We are coming back in just a bit and take all the action forward.